This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everybody, welcome back to the Human Action Podcast. Today I'm going solo, and I am going to walk through what may seem like a dry topic to some of you, but others will recognize the earth-shattering importance of this issue. I'm going to be walking through the mechanics of fractional reserve banking, and in particular, here's what I want to accomplish by the end of this episode, just so you see where I'm going with it. I want you to understand why what the private commercial banks can do right now does give them an advantage over a conventional company, even a big billion-plus dollar company like Tesla, right? That there's a sense in which Citibank has a certain ability in our financial system, namely to create money by granting loans that Tesla does not have, okay? And so this is on the heels of what I'm doing right now, folks. If you caught the episode, I think 2 episodes ago that I did with Jonathan Newman, where we were responding to Richard Werner, who recently was on Tucker Carlson. So this is on the heels of that we realized in discussion, on social media, there's a lot of people who grab onto the fact that, hey, commercial banks, private banks, right? Not the government, but just regular private banks can create money by granting loans. That's the way our financial system works, and that is kind of screwy. But I noticed that many of them seem to think that there's no difference between a private bank and the central bank. And so that's, again, a big part of what I want to accomplish in this episode is to just go through the mechanics of it and show you the sense in which Citibank, yes, is more powerful, can create money in a way that Tesla cannot. However, the Federal Reserve can create money in a way that Citibank cannot. Okay, so that's the main thing I want to accomplish. But then just to round it out, to not merely be beating up on the fans of Richard Werner and also the fans of Steve Keen, if you know him, that in the social media discussions, even though Keen and Werner battled about stuff, they agree on this narrow question of fractional reserve banking versus like a pure credit creation theory of banking. Just to show I'm not just hitting on those guys, I also will turn and feud, as I want to do, with George Selgin, all right? And so that's at the end of this episode, after I go through the mechanics of bank balance sheets and just show you how this stuff works, so you'll understand what I mean when I say Citibank can create money in a way that Tesla cannot, but the Fed can create U.S. dollars in a way that Citibank can't. Then, though, I'm going to deal with the free banking school, who are led by George Selgin and Larry White, and explain why I think their view is lacking as well. All right, so this gets really complicated in the sense of the coalitions and alliances when it comes to the claim about, hey, do private banks, do they even care about reserves? Like this old fractional reserve model that the textbooks had in the 50s and 60s. Richard Werner on Tucker Carlson's show said that view is wrong. I empirically demonstrated it. That no, banks, when they grant loans, they don't care about their reserves. They don't go look in the vault and see, well, how much do we have? They don't check and say, what's our balance with the central bank? Can we afford to lend out more? And then also, in 2020 in the United States, the Federal Reserve completely abolished all reserve requirements, right? So that's another trump card that this school plays, is to say, you idiots, talking to like Austrians who still cling to this fractional reserve model, say, you idiots, what are you talking about? Clearly, banks don't care about reserves. This story you tell your students is totally wrong. Banks just, in the mere act of granting a loan, that automatically creates the deposits. Just out of nothing, ex nihilo. They're not drawing down on reserves from somewhere else. What are you talking about, right? And so I'm saying Selgin and I are allied on that narrow question to tell them that's a misleading presentation, that no, private banks do depend heavily on reserves in the sense that they have to be careful to not run out of reserves, right? Their business model would be doomed if they ever literally run out of reserves, right? They would have to shut down. The public would lose all confidence in them, right? So I'm going to spell all this stuff out in this episode, folks. So I'm saying it's just ironic because Selgin and I are battling the forces of the Wernerites and the Keynesians, not the Keynesians, the Keynesians after Steve Keen on that question. But then Selgin thinks, oh, yeah, absent FDIC insurance, and yeah, he doesn't want a central bank, but in a decentralized market-based private property order, Selgin thinks, yeah, there would be fractional reserve banking, and banks would keep the optimal amount of reserves that, maximize the individual bank's profit, and that would be socially desirable too. Just like you let anyone open up a pizza shop and they can sell as many pizzas as they want with the different toppings. You don't have that micromanaged by judges or bureaucrats. And whatever the pizza shop owners think is the correct thing to do in terms of their business's profitability, as long as they honor their contracts, and so forth, that's what you would want as a free market economist. So likewise with banking. If they want to keep 12% reserves and they think that's the right number, go ahead. All right. And so I think he's wrong for saying that, because I'm a Rothbardian on the question of fractional reserve banking. So I guess in summary, in terms of the various coalitions, then we'll dive into the numbers here. Murray Rothbard agrees that banks do care about their reserves. However, they don't maintain 100% reserves. So he agrees that banks engage in fractional reserve banking. He thinks that's a good way of describing it. But he thinks A, illegitimate or fraudulent, and B, causes the business cycle that Ludwig von Mises spelled out. Richard Werner, when he was on Tucker Carlson's show, says, no, the fractional reserve model isn't really accurate. The better way to think about it is just that when the bank creates or gives a loan, it's just creating that money. Boom, right there. But he also agrees it's fraudulent. Okay. George Selgin thinks that you need to keep track of the reserves. That banks, when they grant a loan, yeah, they create money on the spot. That's true. But they do need to worry about reserves, because ultimately the reason banks have that power to do that is because they can satisfy redemption requests. So that's why reserves are important. However, Selgin thinks, at least if it's done in the context of a market without government subsidies or privileges, it's not fraudulent. He thinks, no, that's awesome. That's capitalism for the win. All right. So it gets a lot of ins, a lot of outs, a lot of interested parties in this. Okay. So I'm just explaining. It does get confusing. However, this is not merely just a bunch of academics arguing about stuff, even though it is that. It's not merely that. I think this is very important to understand what's going on, like in our modern world, but also as people are calling for, auditing the Fed or ending the Fed and things like that. It's important to understand what's going on with banking. And it's not just about banking per se, that if the Austrians are right, this practice is what causes the business cycle. Interestingly, last point I'll make here in terms of the different personalities and who thinks what. In his Tucker Carlson interview, Richard Werner agrees that fractional reserve banking can cause a boom-bust cycle, but he thinks it only occurs if the private banks are, creating money by granting loans for borrowers that want to just go buy assets. He thinks that, that just pushes up asset prices and causes a boom that is going to lead to a bust. He also thinks it's distortionary and illegitimate if what the banks are doing with these new funds that they create ex nihilo is just lending them to consumers to go buy consumption goods, right? Just like running up private debt in order for people to go consume more. He thinks that's also unsustainable and unhealthy. But the one area where he says it's productive, which is weird since he said the whole practice per se, in terms of just the accounting and everything, is illegitimate and fraudulent. So it's weird that he thinks there's a channel through which fraud can promote sustainable economic growth. But anyway, he says is when the commercial banks give loans to productive businesses who are going to borrow the money so that they can, expand their capacity and things like that. All right. So the difference between Werner on that narrow topic and the Rothbardians in the Misesian tradition is that standard canonical Austrian business cycle theory has the banks expanding credit, lowering interest rates to artificially low levels to give loans to entrepreneurs who want to expand their capacity, right? The business people run their profit and loss calculations at the artificially low interest rates and then say, oh, now because, quote, the cost of capital is lower than it was last Thursday, it makes sense for me to go ahead with this long-term project, right? Because now its present discounted value is positive if I plug in a lower discount rate, for those of you who know those terms. All right, so in a Misesian Rothbardian story that says fractional reserve banking per se causes the business cycle, you don't have to decompose and say, well, who's borrowing the money? Actually, in that world, or in that framework, I should say, consumer loans, even though you might argue that it's not helpful to people, like it caters, to their impulses and whatever, to lend to people at artificially low rates that they might load up on debt that later they regret. But that wouldn't cause a boom-bust cycle if it were just consumer loans, or at least it wouldn't be nearly as severe as if it's being lent to the businesses who are then taking the funds to go build factories or to start building a high-rise apartment building or something, where they wouldn't have done that if the interest rate had remained at the earlier higher level. Okay? All right, so now that I've kind of given you a survey of the terrain intellectually, let's dive into it. And so what I'm doing here, if you want to go read the article itself, I have a recent blog post at the Infinio website. In case you don't, Infinio is a company, a fintech company where I'm the chief economist. We're putting life insurance on the blockchain. All right, so that's quote, like my quote day job. And so I have a blog post there where I'm going through all this stuff that we're just going to be flashing some images on the screen here. I should say, I didn't say this at the outset, if you're listening to the audio version of this particular episode, it's not going to be a complete waste of your time, but it would really help if you get yourself in front of a computer or phone and you can watch the video, because I'm going to be walking through, at least for this middle third, some bank balance sheets. Okay. So again, what are we doing right now? In this blog post that I'm going to walk you through, and of course we'll put the link at the show notes page, I am going to try to explain to you the difference between Tesla, which is, the representative, the stand-in for a very big and wealthy private sector company that can't create money, right? What happens when Tesla borrows funds from a household and then lends them out to somebody else at a higher interest rate and earns the spread, right? A private company, you don't need to be a bank to do that. So I'm going to show that's what Tesla can do. And then I'm going to show what happens if Citibank does what looks to be basically the same thing, but it does it via what's called fractional reserve banking. And so I just want to show you the difference in the accounting treatment of those two sequences of events to really underscore the critical sense in which Citibank can create money when it grants loans, whereas Tesla cannot. Okay? And then once I go through that with the numbers, then we can talk about, I won't keep flashing more numbers at you, but we'll talk about what the Fed can do and why the Fed can create money in a qualitatively deeper or more fundamental sense than even Citibank can. Okay, so the basic story that we're going to walk through here is we'll start at snapshot one, looking at the balance sheet of each of these companies. We're going to start first with Tesla, and then there's some guy, Jim Smith, who's going to lend Tesla $100,000. And then Tesla's going to take that money and lend it in turn to a solar panel company. All right, and Tesla's going to earn more on its loan, like, what it lends out. It's going to earn a higher interest rate than what it promised Jim, and Tesla's going to earn that spread. So that's why Tesla's doing this, is to make money. Okay? And in this sense, I'll say before I forget, Tesla is acting as a pure credit intermediary, right? It's just a channel or a vehicle through which Jim Smith's actual savings is getting directed into the ultimate borrower, which is the solar panel company. And here Tesla's kind of just passing it all through. And in so doing, Tesla is not creating money. There's no extra dollars being created because of these transactions. All right, so let's just go through the accounting. There's a little bit of a learning curve here if you don't understand how I'm originally setting up these tables, or T accounts you could call them, but they're pretty intuitive. And then I just encourage you, if you care about this topic, you really need to be able to understand this. And if you can just get over the hump of learning what I'm doing here, then I think that just unlocks everything. And you will be at a 95 percentile or above in terms of social media arguments about this stuff. Because a lot of people on social media throwing words around and phrases, and it's clear they don't really understand how it works. Okay. I'm not saying that I'm right in all of my conclusions, but I can just tell I've thought through this stuff a lot more than most people I'm arguing with on social media who are, telling me, oh, don't you even know the Fed got rid of reserve requirements in 2020, you idiot? Okay. So here's snapshot 1. Happens on September 1st, 2025 at 12 p.m. So this is all going to happen on the same day, these earlier things. We're just going to have the time elapse to show the sequence, and then we're going to jump ahead a year to September 1st, 2026. Okay. So snapshot 1 is just the original base position. I assume Tesla has $1 million in its business checking account, right? So Tesla has a business account with some bank somewhere. They've got $1 million in their checking. As of, in terms of what we're looking at right now, Tesla has no liabilities, right? So the assets are on the left side, the liabilities on the right side. And it's also the way you do these accounts is the assets always equal the liabilities plus shareholder equity. And really, that's just like a placeholder that you're listing the assets on the left side and the liabilities on the right side. And then hopefully the assets are bigger than the liabilities. And so then the difference is what the shareholder's equity is. So intuitively, the idea is if we sold off all of our assets right now for money, and then we had a pile of money, and then we looked at all of our liabilities, which are expressed like in present dollar terms, and we paid them all off, whatever we're left with is, now there's no other claimants on that pile of money, and we've sold off all the other assets, so now we're just sitting there with a pile of money, and then the shareholders collectively own whatever's left there. And so that's why that difference is the shareholder equity. And so if you own 15% of the shares of stock of this company, you would own 15% of that remaining pile of money. That's the intuition behind this kind of accounting treatment. Okay? So to do that, these items, at least on certain conventions, certainly economically, the way I'm handling this right now is we're going to be plugging in what is the current market value of each of these assets and liabilities, okay? So starting out again, right now, Tesla, assuming it's got $1 million in its checking account, and it got that from the original shareholders. When they, kicked in to become shareholders of Tesla, that's what they gave the company, okay? And so that's why you can see on the left, the total assets are $1 million, and on the right, total liabilities plus equity is $1 million. There are no liabilities right now, okay? Snapshot 2, an hour later, Tesla borrows $100,000 and it's promising a 5% interest rate, right? And it's from this guy his name is Jim Smith. So he writes a check for $100,000 made out to Tesla. Tesla deposits that in their bank. So now Tesla's checking account balance jumps up to $1,100,000. And so, you say, so did that mean the shareholders' equity just jumped up because the asset? No, because now they have a liability. They owe this guy, Jim Smith, he has a bond issued by the Tesla Corporation that right now has a market value of $100,000. But what it's actually promising is that in 1 year's time, the bearer of this bond will get paid by Tesla $105,000. That's technically what the bond is promising. And so right now, in terms of a 5% yield, the market value, that's $100,000. Or put the other way, the reason Tesla sold it to Jim for $100,000 when what this thing is actually promising is a year from now, it's going to pay $105,000 is because there's a built-in yield of 5%. Okay? But right now, again, in terms of the liability at this moment in time, at this snapshot, the liability is $100,000. So since they've got total assets of $1,100,000, represented by Tesla's checking account balance. And now they got this liability that has a market value right now of $100,000. That's why the equity is still $1 million. And that makes sense, right? The mere act of just borrowing money from somebody should not have changed the equity of the shareholders, right? You can see that the assets and total liabilities and equity just each went up by $100,000. If you know these terms, you could say right now Tesla is more leveraged than it was before it took on this loan. Okay. But it didn't change the equity of the shareholders. Jump ahead. Snapshot 3, an hour later, Tesla now lends $100,000 to the solar panel company. They've got some of a childish name, Panels R Us, okay? And what this bond does, technically, it doesn't pay a coupon, if you know what those terms mean. It just says the owner of this, the bearer of this bond in 1 year's time will get $108,000 from the company Panels R Us when you redeem our bond. All right. And Tesla only pays $100,000 for that right now. And so there's a built-in 8% yield on that. Okay. And so now this is important. We're going to come back to this later, but the transition from snapshot 2 to 3, look at what's happened here. Tesla's assets have not changed. They've not gone up. They've not increased. It's still $1,100,000. It's just the composition of their assets has changed. Namely, when Tesla bought that bond from Panels R Us, they wrote a check, or they electronically wired the funds or whatever. And so Panels R Us took that payment, deposited it in their bank, whether it's the same bank or a different bank, it doesn't matter. From Panels R Us's point of view, their checking account balance with their bank went up by $100,000, and Tesla's checking account balance went down by $100,000. That's what happens when you're a regular company and you buy things. Your checking account goes down, if you're buying them with a check, right? Okay. But the assets didn't drop in sum because they, at that instant, by, giving up $100,000 of their checking account balance, Tesla acquired a bond that was their asset from this company, Panels R Us. And what's the market price of that bond right now? Oh, it's $100,000. Okay? So that's why going from snapshot 2 to 3, the total assets, the value didn't change. It's just the composition changed. Okay? And then since it's an accounting rule in this type of a setup, the total assets always have to equal the total liabilities plus shareholder equity. If the left side is still 1.1 million, well, then the right side's got to add up to 1.1 million. And specifically, we can see what happens is that, the liabilities are still the same and the equity is still the same. All right. So there was no change on the right-hand side, not only just in terms of the total amount, but also the composition stayed the same. Okay. So again, just to summarize, when Tesla borrowed the money from Jim Smith, its assets and liabilities went up by $100,000 on both sides. It became more leveraged. But then when it lent money to Panels R Us, that didn't change the size of the balance sheet. It just changed the composition of the asset components. Okay? And in particular, no money has been created here. It's Jim Smith gave $100,000 to Tesla, and then Tesla gave that $100,000 to Panels R Us. There's no extra dollars that were created by any of these transactions. So now, just to round it out, suppose the year passes and we check back in. Snapshot 4 here. Panels R Us, we assume, has had a profitable year. They're fine, so they come and then they write a check for $100,000, give it to Tesla to redeem the maturing bond, because that's what they owe. If Tesla just held on to that bond for the full year, that's what Panels R Us owes them. So, Tesla gives them the matured bond. Panels R Us writes them a check for $100,000, and Tesla deposits this in its bank account, right? So you can see on the left side here, that bond is no longer an asset because it's matured away. It's gone. But Tesla now has $1,108,000 in its checking. So that's what the assets are. On the liability side, because we're we're doing the sequence here just to walk you through it. We assume that Jim Smith has not yet redeemed his bond from Tesla, right? So that's still on the books. But notice it has grown in market value, right? Because right now it's just an hour away from being redeemed. So during the course of that year, even though a year ago when it was first issued, it only had a market value of $100,000, now as the 12 months have passed, it has matured. And right now, moments before redemption, if you had to put a market value on that thing, it'd be $105,000 because Jim Smith's getting ready to turn it in and get $105,000 in cash, right? So that's why Tesla's equity is only $1,003,000, even though they've got $1,108,000 in their bank account. Okay, and then just to round it out, an hour later, Jim Smith shows up. He hands over the matured Tesla bond that entitles him to a $105,000 payment. Tesla writes him a check for $105,000. And so that's why when that check clears, and now we look at Tesla's balance sheet, its checking account balance has fallen down to $1,003,000. And that's what the assets are showing. It's got no liabilities at this point because it paid off Jim Smith. And so that means now those assets have no offsetting liabilities. So that $1,003,000 is the full equity that the shareholders now enjoy. And so when all is said and done, big picture, you step back. We started out with the shareholders having equity of $1 million. They end this process by having equity of $1,003,000. So they earned $3,000 somehow. And where did that come from? Well, it's obvious. It was the spread on those interest rates, right? Tesla borrowed at 5% and lent out at 8%. So earning that 3% spread, and that was on a principal balance of $100,000. And so 100,000 times 3% up is 3,000. So that explains where that came from. All right. So there, this isn't automatic. The panels RS could have defaulted, for example. Or, why doesn't every company just do this and make money automatically? Well, or you could say, why did Panels RS have to pay 8%, whereas Tesla could borrow at only 5%? And the answer, I'm making up those numbers, but the spirit of it is because Tesla is a big company that's reputable. So people who have, Jim Smith, who has funds to lend, you might say, why would he lend to Tesla at 5% when Panels RS is willing to sell bonds offering 8%? Well, because Jim Smith doesn't trust Panels RS as much as he trusts Tesla. That's why. Okay, so those things are all, components of the story to make these numbers work, to explain why this opportunity exists. But that's the idea. Okay, so Tesla, again, in this case, has acted as a pure credit intermediary. Incidentally, let me just mention, you might think like that $1 million that Tesla had in shareholder equity that I started out with, you might say, what function did that serve in this story? Couldn't I have just gotten rid of it? And I think, I might be wrong, but I think in a lot of the examples that Rothbard does, like in his case against the Fed and maybe the mystery of banking, when he gets into the T accounts and stuff, I think he doesn't include that stuff. I just remember when I started doing these things, I had a little bit of a different treatment from Rothbard. And I think that was one of the elements, that he was kind of just doing like the debits and credits in terms of double entry bookkeeping. So what he was doing was perfectly correct. But for me, I thought it was more intuitive and you could really understand the economics of what was happening if instead of kind of just showing what the accountants would write in terms of the updated transactions, in terms of which accounts to debit or credit, just to kind of keep taking static snapshots of the whole balance sheet after each transaction occurred. Just for whatever reason, I thought that was more intuitive and kind of gave you a sense of what was really going on. But also too with this, if Tesla didn't have a layer or a foundation of shareholder equity, then if things went wrong, it would be hard to explain what was going on, right? That in this case, for example, if Panels RS had defaulted and just didn't pay them, they went out of business and said, sorry, and that was tied up in the courts. And then Jim Smith comes calling. at least in this example, well, Tesla still had the $1 million in its checking that it could have paid Jim Smith that way. And so it's like the shareholders were risking their original capital in order to earn this hoped for 3% spread. All right, so things get trickier when, what if they're so levered that if things went south, they would be wiped out. That gets trickier. All right, so that's partly why I included that, is just to, explain intuitively. Effectively, the shareholders were putting their own money on the line to sort of guarantee, as it were, this transaction, and that kind of explains why Jim Smith would be comfortable lending at 5% when there's somebody else lending at 8%, is because he knows, no, I'm pretty sure Tesla's good for this. Okay. Now I'll go more quickly through the second scenario, since you're at this point, if you've stayed with me this far, you're more comfortable now with how these balance sheets work, or at least the way that I present them. So we're going to do a very similar scenario, except instead of it being Tesla, that's the company involved in the borrowing and the lending, it's Citibank. Okay? And so superficially, it's going to look like it's basically the same thing, but there's a few critical differences that I'll emphasize as we go through it. Okay, so originally, we start out from, the default position. No pun intended with saying the word default. The baseline position, put it that way. Now here, it doesn't make sense to say, what does Citibank have in its checking account? Because Citibank is the bank. They run people's checking accounts, right? If you were going to talk like that, you would mean Citibank's account with the Federal Reserve, but I don't want to bring them into the picture right now because that just is going to make it more complicated. So here, in this analysis, we're not going to invoke the central bank. We're just going to say Citibank is a private commercial bank, but we're not going to rely on the central bank coming in and possibly rescuing them, all right? So what the analog of a checking account is for a commercial bank is vault cash, all right? So originally, the shareholders, we assume, all contributed collectively $1 million in currency, right? So this is still, we're assuming it's in the United States and they use US dollars as their money, all right? So in the vault, you've got a bunch of singles and fives and tens and 20s and $100 bills. You got $1 million worth of actual green pieces of paper currency in the vault of Citibank. And that's how they start out. Right now they have no liabilities. And so assets are $1 million in cash and liabilities plus equity are, and no liabilities. So the shareholders' equity is $1 million. Okay. Next step. An hour later, Jim Smith walks into Citibank. He's got suitcases full of cash. We're not going to ask questions as to how he got it. He says, yep, I'd like to put this in open up a brand new checking account with you, and I want to deposit this $100,000 in cash into my checking. They say, okay. So what happens? They take the cash and they put it in their vault. So in terms of Citibank's assets, after Jim Smith, and he gets a new debit card and he gets a checkbook and he gets a slip that acknowledges on this date you deposited $100,000 into your checking, and that's now what your current balance is. He walks out with that. So if you now turn to the accountants of Citibank and you ask them, what are your assets? They're going to say, oh, we got $1.1 million in actual currency in the vault. Shareholders' equity, however, has not gone up by $100,000, hasn't gone up at all. So what happened is, because their liabilities also went up by $100,000. Namely, Jim Smith is now walking around town thinking that he can spend $100,000 of his balance with Citi. All right. So there's a sense in which Citibank owes Jim Smith $100,000. In particular, if he just showed up and said, you know what, I want to take my money out, they would have to give it to him. And so that's the sense in which they have this liability. They can't ignore that fact. In order for them to get that $100,000 from him and put it in their vault, they had to give him a promise, which was, you can write checks, in which case merchants around town or other people can demand payment from us, or you yourself, Jim Smith, can go to ATMs and take out some of your cash that way, or you can come to our branches and, so that's the idea. All right, so in terms of the accounting, you can see how that works. So notice, just as with snapshot 2 in the Tesla case, here the assets and liabilities both jump by 100 grand. I forgot to mention, there's a 5% yield on the checking account balance, okay, that Citibank offered. So that was part of the deal. Nowadays, people this might not resonate with people, but historically, checking accounts did pay interest, particularly when, conventional interest rates were higher than they are right now. All right, so just for this example, just to keep it as consistent with the prior one as possible, we assume that what Citibank says to Jim is, hey, if you just let that $100,000 sit here and you don't touch it, a year from now, you'll have $105,000 in your checking account, right? Because we're going to be paying you interest along the way at the rate of, 5% annual percentage yield, okay? So jump ahead now. What if, though, at that moment or an hour later after Jim Smith leaves, Panels RS, their president or CFO or somebody comes into the bank and says, yeah, we want to borrow $100,000. And Citibank, they analyze the company's financials and business model and so forth, and they say, yeah, we'll grant it to you, but at an 8% interest rate, we want to get paid back in a year. Panels RS says, sure, that's great. They sign the IOU or whatever. They leave. And at this moment, and this is critical, consistent with what Richard Werner was saying on Tucker's show, it's helpful to isolate the pure accounting move here. Don't assume that the bank teller walks back to the bank vault, opens it up, and takes out $100,000 in cash and puts it into some bags or whatever, and then hands that over to the representative from Panels RS. For one thing, that's that's not how it would work. Like, people don't want to be walking around with that much cash. But also, in terms of the accounting, where that really isn't typically how it works, right? When somebody takes out a loan from the bank, the immediate thing that happens in the wake of that approval is the borrower has a checking, if they originally had a checking account or they open up a new one, and then that is credited with the loan amount. Okay, so I'm saying what happens here is when the bank approves the $100,000 loan to Panels RS at an 8% rate, there's two things going on. On the one hand, Panels RS signs an IOU, or maybe there's a bond that they officially issue to the bank, and it's like the bank is buying the bond. So that explains why, Panels RS a year from now is going to owe Citibank $108,000 because of this bond that's on the side. But then also what happens is Panels RS is granted a checking account with Citibank, just like Jim was. They get a checkbook, they get a debit card, information, and here's how you go online and establish your PIN and log into your account for the first time, blah, blah, blah. And they've got $100,000 in that account, right? They go take that new ATM card and they go to the ATM and type in their PIN, say check balance, it'll say 100,000. Right? So their checking account is indistinguishable from Jim Smith's. Right? They both think they have $100,000 in their Citi checking account. Somebody just looking at those numbers or asking some questions about it, the nature of those claims on Citi, would not be able to determine and say, oh, well, Jim Smith's is like really money in checking because he got it by bringing in physical cash, whereas Panels RS, they think they have $100,000 in their checking account too, but really that's just because of a loan that really, no, you wouldn't know that. They're indistinguishable, they're interchangeable, they're fungible, okay? So notice when Citi grants the loan to Panels RS, the assets and liabilities jumped again, this time to $1.2 million. The liabilities and the equity, I should say, right? That didn't happen in the Tesla case. Remember, with the Tesla case, when they made the $100,000 loan to Panels RS, that just changed the composition of their assets. But here, at least in the initial transaction, it didn't change the composition of the assets. Citibank still kept all the currency in their vault, and they added the bond from Panels R Us on top of it. So that's why their total market value of their assets went to $1.2 million. And again, the reason is when Citi grants a loan to somebody, it increases Citibank's liabilities. Because that's the way they grant the loan, is they say, we're going to give you the ability now to walk around town saying we owe you $100,000 because other people will accept our liabilities as if they were the same thing as green pieces of paper, at least in many circumstances, right? So when you go into a grocery store and they ring you up and they say, you owe us $80, you can pay them with four $20 bills, Andrew Jackson's in your wallet or your purse, or you can take out your debit card issued by Citibank, swipe it, and say, I'll pay that way. And so what's technically happening there, it's not that Citibank in that moment is airdropping them or sending via carrier pigeon or courier $80 in cash. No, what's happening is Citibank's computers interact with the merchants, and Citibank is saying, oh yes, right now we owe this, this person who's in line at your store is one of our customers. We owe them whatever, $800 if that's what they have in their checking account. And now they're trying to pay you $80. So what that means is we will subtract $80 from what we owe them, and now we'll say we owe you $80. So if that store already has a checking account balance with them, it's real straightforward. Citibank just says we'll debit the customer's balance with us by $80 and credit yours. So all they're really doing, though, when you think about it, is Citibank is just transferring who owns its liability or to whom does it owe the money, right? And again, so that's qualitatively different from what Tesla did. When Tesla lent $100,000 to Panels R Us, they did not say, okay, here's how we're going to lend you the money. Here's a piece of paper saying the owner of this can present this at any Tesla branch and get $100,000 in cash. And just here, people trust that you go around, you can spend that. That's not what happened. No, when Tesla lent $100,000 to the borrower, they wrote a check, right? They gave him their money or their claims on money. They didn't go further into debt in order to grant somebody else the loan, all right? And so, again, in terms of the accounting, I'm just repeating myself, but just make sure you get it. The way you see that is when Tesla lent the money, its balance sheet did not change in terms of the magnitude. It just changed the composition on the asset side. When Citibank lends money, its balance sheet goes up on both sides. The assets go up because they get, the liability from the borrower, and its own liabilities go up because the way it, quote, gives money to the borrower is just marking up how much do we owe you upon demand. Because, again, so why is that? It's because in our community right now, private banks, at least reputable private banks that, are in good standing with the government, the regulators, and blah, 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 especially if they have a good name recognition, and you can see, there's a branch down the street. I know where to go if I have an issue with this bank. I can find them, right? Banks that enjoy that reputation, the way our system works right now, liabilities on them are treated in many cases as interchangeable with actual cash, whereas that is not true for a normal company's liabilities. In general, if you go into the grocery store and you owe $100 for the groceries, you can't take out a Tesla bond and say, I'm going to pay with this. Whereas you can effectively take out a Citibank bond, isn't the right word, but demand claim and say, I'm going to pay with this, because those circulate as being virtually the same thing, at least in many circumstances, as the money proper. And that's fundamentally why banks have this ability. And just to anticipate, that's what Mises put his finger on and said back in 1912 in the theory of money and credit. It took him a long time. He built up the framework to explain all this stuff economically and theoretically. But then, he culminates with, because bank notes or demand deposits are, at least in many circumstances, accepted at par with money proper, or what he called money in the narrower sense, that's why banks had this ability to inflate the money supply, because liabilities with Citibank are included in the money supply, whereas liabilities with Tesla are not. If Tesla borrows money from you and now you have a bond from Tesla, that doesn't increase the money supply. But when Panels R Us borrows $100,000 from Citibank and Citibank grants them the loan, and the way they do so is initially just marking up their checking account balance, the money supply in that economy just went up by $100,000. Because what the broader aggregates, things like M1 and M2, they include checking account balances in the list of things that you add up to come up with what's the stock of money or what's the money supply right now. Checking account balances count in M1 and M2 and higher ones. And so notice in this example, when Citibank grants that loan, total checking account balances went up by $100,000. So that's what we mean when we say Citibank here, just in a sense, created money. Okay. I'm not even going to go through the rest of the snapshots here. It's pretty straightforward, though, just to walk through if both party, if the solar panel company comes back in a year's time and puts in $100,000 and pays off its loan, and then Citibank, let's say Jim Smith then says, okay, I'm taking my money out now. It's $105,000. He walks away. When the dust settles, Citibank has $1 million or $1,003,000 sitting in vault cash and no liabilities at this point. The customers have closed their accounts, and so that's why their shareholder equity went up to $1,003,000. So same kind of thing. They earned money on the spread. It's just what happened in between was trickier. Okay, so I think there I walked you through what happens in terms of how Citibank is more powerful than Tesla and can create money in a way that Tesla cannot. Okay. Now, quickly, does that mean, therefore, so the way our financial system works, the money is created by the private banks, and that's the source of money, end of story. And they don't need to rely on reserves. I mean, even in your example there, Murphy, they didn't take cash out of the bank and that's because I glossed over some important elements. Okay, so in particular, if we just focus on going from snapshot 2 to 3 in the Citibank example, Citibank grants the loan of $100,000 to Panels R Us. Now, I didn't show it here because there was a lot of complications. We just jumped ahead a year to then say, okay, suppose Panels R Us comes back in a year and pays $108,000 to retire that bond, blah, blah, blah. But right here, Citibank has to be careful because think of it this way. What's the point of Panels R Us borrowing the money is they're going to spend it, right? That's the reason they're borrowing the funds is they have things they need to do with it. So they go and write checks or whatever. Some of those, and let's say they spend $100,000 shortly after getting it, paying employees maybe or buying materials, who knows what. If the recipient of the check that Panels R Us writes is also a Citibank customer, then it's okay. Then Citibank is fine. It just, let's say it's a $20,000 check that Panels R Us writes to somebody else who happens to also bank at Citibank. That's fine. Then Panels R Us's checking account goes to $80,000 and that other company's checking account goes up to $20,000. So that's fine. That doesn't change the total liabilities of Citibank. It just changes their composition. But what happens if Panels R Us spends $100,000 buying something from some supplier who banks at Bank of America? Well, now what happens? So that person accepts the Citibank check, deposits it in his own account with Bank of America, and now during periodic clearinghouse operations, Bank of America says to Citibank, hey, one of our clients has a check written by one of your clients on you for $100,000. And you in this period don't have any offsetting claims from, our checks our clients wrote to your clients. And so here, we're presenting this. to you for redemption. And so here, if they're peer banks, in general, the way they settle up is Citibank has to take $100,000 in cash and give it to Bank of America. Now here, in reality, they could also, if they both have accounts with the Fed, they could just transfer reserves that way. All right. So, but I'm trying not to bring the central bank into this just to not complicate things even more. But I'm saying whether it's cash in the vault or balances with the Fed, either way, those are what are called reserves. When we talk about in the context of banking, what are reserves? It's when it's the physical cash in the vault or the balances that bank has with the central bank. Those are reserves. And so I'm saying when banks, that are on a level playing field, that are peers, but they're private commercial banks, when they settle up with each other, when one bank's customers have written more checks or swiped more debit card purchases vis-a-vis the customers of the other bank, and they settle up, they do it by transferring reserves. Okay, and so that's why Citibank has to be careful on the front end. They couldn't have given Panels R Us a loan for $2 million because then over the course of the year, if Panels R Us spent too much of that with clients who are not Citibank or with people who are not Citibank clients, and then those got presented for redemption, Citibank could have run out of vault cash. And then they would have been in trouble, right? The reason the community accepts liabilities against Citibank as being at par with actual cash is because in practice, you can convert them one-to-one. That's why when you go to the grocery store and you swipe your debit card, they're fine with that because in practice, they realize that, getting $100 because now Citibank owes us $100 or just getting a Benjamin Franklin piece of paper is kind of the same thing. If I want to, I could say to Citibank, hey, you owe us $100. We have $100 in our checking account now with you because of this customer swiping his debit card. Our tills are getting short. We want some cash. So instead of you owing us $100, just give us a Benjamin Franklin. Citibank has to do that. It's a demand deposit. If Citibank repeatedly told merchants, we actually don't have it right now, come back to us in a month, they would go out of business. Merchants would stop letting customers swipe Citibank debit cards because they would say, no, that's not the same to us as cash because Citibank has shown when we say, give us the cash, they sometimes say no, right? So I'm saying that's why reserves are important. Notice in this story, I haven't said anything about reserve requirements. I'm not saying because the government's imposing some regulation. I'm just saying in this example, it's crystal clear. Citibank is okay giving Panels R Us a $100,000 loan because worst case scenario, their vault cash gets drawn down and they're fine. But they couldn't give them a $2 million loan because then they're opening themselves up to people drawing out and emptying their vault of its cash. And then if just some random customer wants to hit up the ATM or just go to the teller, and say, I need $80. If the vault is out of cash, they say sorry, and then boom, they're done. Okay, so that's why reserves do play a role, even if you understand the sense in which, there's pure credit creation. Okay, so notice in this story I'm telling, I've hit both things that Werner emphasized. His point was, in the moment of granting a loan, there's no reserves involved. It's just pure, the liabilities and assets go up simultaneously in a bookkeeping operation. Deposits are created at the same time that loan is generated. So what do you mean? There's no pile of money that's drawn down. That's all true. And yet, as I've shown, if that's where you stop the analysis and said, so reserves never enter it, you would be wrong. You would not be giving an adequate explanation of how banking works in our world right now. Because another way of putting it is, why couldn't bankers just all be trillionaires? Why don't they just all loan their boards of directors trillions of dollars, right? If banks can literally create money with no restraint, right? So clearly there are constraints, and I'm walking you through one way of seeing it. In contrast, the Fed has no such constraints because the Fed's liabilities are equivalent to cash, right? A conventional commercial, here's one way to put it. When Citibank, if it has $100,000 on deposit with the Fed and they say to the Fed, hey, we'd like our $100,000. We don't want to have a checking account balance with you of $100,000. We want the actual cash. The Fed can just tell the minting, Bureau of Engraving and Minting or whatever the title is, print up $100,000 and give it to them, and they will. If Citibank, if its clients show up and say, hey, we have $100,000 in our accounts with you, collectively, and we want the cash, and they don't have it in their vault, they can't just run a printing press and pay them off that. No, they have to just go out of business. Okay, so that's the fundamental difference, that the Fed can create what's called base money. When the Fed buys assets, buys $1 billion of mortgage-backed securities and kind of writes a check on itself, yeah, it creates the liabilities in the same way that Citibank does, but the Fed's liabilities in our system are equivalent legally to $100 bills. And the way to see that is, look at your $100 bill. What is it? It's a Federal Reserve note. Okay, so that's the sense in which when the Fed creates dollars through granting loans or buying assets, that's the same thing as creating cash. Whereas when Citibank does it, it's not quite the same thing. So again, Citibank can, quote, create money in a way that Tesla can't, but it can't create money in the same fundamental sense the way that the Fed can. Okay, I very, very quickly here, just to round out, so that's kind of my issue with Richard Werner and his presentation on Tucker's show, and Jonathan and I went through that, but we kind of used more academic language. Quickly here, what's my beef with George Selgin? So I think Selgin would agree with just about everything I said up to this point. But my problem with them is, now that I've walked you through all this stuff, I think it's crystal clear to see why Mises and Rothbard and, Joe Salerno and Hans Hoppe and Guido Hulsmann, Walter Block, lots of people in the Rothbardian tradition who've written a lot on fractional reserve banking over the years, why they think it's illegitimate and why it causes the boom-bust cycle. Okay? And here, let me just do it real quickly. So now that you understand the sense in which banks can do that, there's something weird, right? When Jim Smith bought the bond from Tesla that, yielded 5%, and then Tesla lent it out, Jim Smith knew he couldn't spend that $100,000 for the year, right? He had given his money to Tesla. He has a bond and maybe it's liquid, but if he wanted to go spend something, or buy something, he would have had to sell the bond to somebody else for money to then go buy whatever he needed. And if interest rates had changed in the meantime, he might have suffered a capital loss on the bond, right? In contrast, when Jim Smith deposits his $100,000 into a commercial bank checking account like Citibank, he still thinks he has the $100,000. And so then if Citibank goes and lends $100,000 to Panels R Us, it's like, where'd that come from, right? It's like a company was getting a loan even though there's no genuine saving behind it. Whereas again, in the first example, Jim Smith abstained from consumption. He saved, and Tesla just channeled that savings into Panels R Us's account, right? So it makes sense there. But in the second case, it's not obvious how was Citibank granting a loan to somebody, right? So when you see that, to me, that's the essence of what Mises is talking about when he says this practice of fractional reserve banking causes the boom-bust cycle because, again, when banks have this ability to expand credit, they advance loans for which there has not been prior saving. So there's some kind of mismatch economically, and then mechanically what happens is to get the higher volume of loans out the door, the banks lower the interest rate, and so that gives the wrong signal to entrepreneurs. Like, interest rates are prices, so in terms of economic calculation, you think it's important for market prices to be correct, to do their job. Well, yeah, that if with 100% reserve banking, the interest rate would have been 8%, and now with fractional reserve banking, the banks can lower the interest rate down to 4%. The idea is like that 4% is artificially low. That's the wrong number. Businessmen should not think they can borrow at 4% because households really aren't saving that much. Okay? So that's kind of the way to, now that you understand the mechanics more, that I would explain the problem with fractional reserve banking and why it's intuitive to see, oh yeah, that causes a boom-bust cycle because businesses start a bunch of projects for which there's not adequate real savings to get them across the finish line. There's this apparent prosperity up front, but it's unsustainable and there's a crash, okay? So what was intriguing to me is long ago I debated George Selgin at the Soho Forum on this issue of does fractional reserve banking cause the business cycle or lead to economic instability, something like that was the resolution. And so I thought, this is unassailable. How could anybody dispute that? And in his work, though, the way Selgin tries to answer that objection, he said, no. With fractional reserve banking, again, as long as it's not subsidized by the government with FDIC and lender of last resort, central banks and things like that, but if it's just genuine private sector, the banks can do whatever they want. It's just if they expand too much, if the reserve ratios are too low and they get caught, then, they go under. So Selgin's for contract enforcement, but he's saying as long as they can get away with it and their customers are happy and nothing bad happens, they get my blessing, right? And that's economically productive. And so specifically what he said is if a bank engages in fractional reserve banking, and he agrees interest rates would drop to other things equal to get those extra loans out the door. He says there is saving though, right? So that explains why the falling interest rate is correct. And he says because an individual who holds a banknote is thereby granting a loan to the bank that issued it, right? And so here, don't think of it electronically. It's just easier to think of it in terms of paper notes. But the idea is think of a world where there's gold coins as the money. And the way banks work is people deposit their gold coins in the vault, and then the bank gives them, rectangular paper notes that say the bearer of this note can go to any of our branches and get 1 ounce of gold coin or 10 gold coin ounces, things like that. And then those notes can circulate in the community at par with the actual specie, the actual metal, money. Okay? And so if it's 100% reserves, it's just a matter of convenience, right? The total stock of money hasn't increased. Some people don't want to be carrying around a bunch of heavy coins. They put them for safekeeping purposes with the bankers, and then they get convenient notes of various denominations that they can, have in their wallet, and people don't realize how much money they have on them, that kind of stuff. But again, as long as each note circulating in the community is backed up 100% by gold now safely in a vault somewhere, that doesn't really cause economic distortions, right? It doesn't expand the money supply. The interest rate doesn't change just because of that. But now what if the banks, okay. And so, but Selgin's saying a person who, let's say there's a guy, he gets paid 100 notes from his employer and he only spends 80 of them. And so he adds 20 notes to his cash balances. Selgin wants to say that guy is saving, right? He could demand, the money from the bank, or he could go spend it, but instead he's saving it. So Selgin is saying the act of someone holding a banknote is in effect granting a loan to the bank. And another way that Selgin views it is he says, yes, if you go and turn your gold coins over to the bank and they give you notes in exchange, it's like you're making a very short-term loan to them, an instantly callable loan. And that note is like, the legal document showing that, yes, I can call this, I lent 1 ounce of gold to the bank in the form of that coin that I gave them. They gave me this piece of paper, and this paper legally entitles me to call the loan and get my coin back, or a coin back at any time, right? And so that's the sense in which Selgin thinks people holding these paper notes, these bank notes, are thereby lending money to the bank effectively. So that's why he's saying, so in a fractional reserve free banking system, which is the term they use, free banking, when the banks issue more notes by making loans to people, as long as the community ultimately adds those notes to their cash balances and they don't, find their way back to the banks for redemption, then the banks are fine, right? And in terms of the individual banks' constraints, they would, other things equal, want to issue more notes charging interest as long as they thought they could get away with it and the gold coins in their vault wouldn't go to zero. And so that's kind of what's going to guide them. They're going to say how much, given the community and their preferences and their willingness to add more of our notes to their cash balances, can we lend more and more with our given stockpile of coins in the vault? Or, can our reserve ratio get lower and lower? At what point on the margin would the bank say, nah, I don't think we should lend more. I don't think we should print up more notes and lend them out to people without having more coins in the vault to kind of back them up as our reserve. On the margin, they would stop when they would realize, at this point, I think we've created enough notes that eventually will find their way into various people's cash balances, that if we tried to print more, nobody in the community right now wants to hold more of our notes. We've kind of saturated that. And so if you could get someone to borrow more, no problem. But when they spent it, eventually it would soon reach somebody's hands who would say, I don't want to hold on to this. I'm going to present it to the bank that issued it. Or they would deposit it at their own bank, and then in clearinghouse operations, it would come back to the issuing bank, right? So that's kind of the check on an individual bank in a free banking model, okay? So again, Selgin is saying, it's fine. It's not distortionary if they're correct in their entrepreneurial judgment and they issue more notes, pushing down their reserve ratio, right? Because they've only got the same stockpile of gold coins in the vault. We're just presupposing they're just printing more notes and lending them out into the community for a given stockpile of coins in the vault. And then nothing bad happens, and there's a new equilibrium, and those notes all find their way into various people's possessions, and they just add it to their cash balances. And now those notes are held in the community, serving as a substitute for money. Well, then that community, the holders of those notes are granting credit to the bank in Selgin's framework. And so it's not artificial credit expansion, that it's not that the bank is lending more than there's genuine saving. They're saying, no, the people who are holding the notes in the very act of doing so are lending to the bank. So it all matches, right? Okay, so very quickly, let me just explain to you why that doesn't work. Right, so it's very clever, right? Again, he's not ignoring the objection; he's trying to meet it head on. So at first, I was like, "Oh, that's interesting, that's clever." But when you think it through, it doesn't work. All right, and here's why. Okay, start with a simple case. Somebody comes up with 100 ounces of gold, like 100 coins, 1 ounce each, gives them to the bank, and the bank then gives them the 100 notes. So there. If you want, you can say that the person lent the money to the bank, and then the bank issued the notes to the person. Okay, I don't have a problem with that. I don't think that's what's going on economically, because the person thinks those things are spendable. But if you wanted to say that's a loan, okay. But now when that person goes around and spends the money, that's not new granting of credit to the bank, right? If that person goes and spends 20 of those notes, and somebody else voluntarily adds those notes to his cash balances and doesn't present them to the original bank for redemption, and just walks around now with that 20 in his cash balance, you can say that second person effectively lent the bank 20, if you want to talk like that, but then by the same token, the first person dissaved by 20, right? By him getting rid of the note, showing I don't want to hold this, he withdrew his credit, okay? So there was the community per se, just by rearranging the notes, is not granting additional credit to the bank. I hope everybody agrees with that. I think Selgin would agree with that too, okay? And so now the question is, okay, but thus far, a Rothbardian wouldn't have a problem with that. Rothbardians don't have a problem with 100% reserve banking. If someone comes and gives 100 gold coins to the bank, and they give him 100 notes that say the bearer of this note, can turn this in at any branch and get 1 gold coin. If that's all the bank did, and so at any given moment, all the notes in the community correspond 100% to coins in the vault, that's fine. That's not distortionary. And again, I think it's a little bit weird, but if you want to say that original depositor lent 100 gold coins to the bank, okay, fine. But now the question is, given that now the bank prints up an additional, let's say, 50 notes. Let's keep the number simple. Let's say they print up additional 100 notes, right? So it brings the reserve ratio down to 50%. Otherwise, the arithmetic's going to get tricky, right? So there have been no new deposits. Nobody else brought in actual gold coins. They've still got the 100 gold coins in the vault. There's still the original 100 notes that are out there circulating in the community. And you can say with each transaction, one person dissaved and the other person saved, and they cancel out. So the total gross saving in the community, or net saving in the community, is still the same, okay? But now the bank prints up an additional 100 notes with no new deposits of gold coins, and then finds somebody and says, hey, do you want to borrow this from us at 3%? And the person says, okay. So we're going to give these 100 notes right now. You sign your name. A year from now, you owe us 103 ounces of gold. You can pay us in notes or you can pay us in coin. But a year from now, you agree you owe us 103? And the person says, yes. Okay. So now that person goes out. So that, in order to do that transaction, interest rates, other things equal, have to be lower than they were the week before, right? Because before, presumably, the interest rate is what balanced the quantity demanded and supplied of loanable funds. So now if they want to issue a new 100 ounces worth of loans, the bank has to lower rates below what the market rate was. So the Rothbardian critique is you're pushing rates lower than the time, what corresponds to time preference. The community hasn't saved more, and yet now this bank is granting a new loan of 100 ounces. Where'd that come from? Nobody saved it. And Selgin wants to say, oh, that borrower, he saved it. And I want to say, okay, this is the last point I'll make, folks. Just bear with me here, but it's important. If you want to say that guy is making a loan to the bank by holding on to the notes, okay. But notice what else happened in that transaction. He borrowed from the bank too, right? Right. In terms of the balance sheet, yes, the bank, its liabilities went up by 100 ounces by him granting him those bank notes. And that's the thing Selgin wants to point to say, see, you're granting credit to the bank when you hold their notes. Okay, but by the same token, in that very transaction, the bank's assets went up by market value of 100 ounces too, when that guy signed the IOU. Okay, and so just in terms of man on the street, common sense, the guy started out with nothing. He walks into the bank, he signs an IOU saying, I'm borrowing 100 from you at 3% interest. The bank prints up 100 notes, hands it to him. The guy walks out of the bank. And I believe the way Selgin would explain that is that guy just made a loan of 100 ounces to the banker. And that explains why the fact that interest rates definitely went down for that to happen is correct, because now there's been more saving in the community. And I just want to say there's no way you can make that work. In the aggregate, there has not been more saving in the community. Okay. I will stop there. I know this perhaps was laborious at points, but I hope you agree if you stuck with me this far. It was edifying. In any event, we'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.